Good afternoon, everybody. I'd like to welcome you to the Mortgage Madness webinar today. I'm Michael Parker. I'm the CEO here at Security Advantage Federal Credit Union. I've been here since 2006. It's been a good 16 years here. We've seen a lot, especially the mortgage market. Since coming here, obviously 2007 through 2009 had the original mortgage crisis for us. And there's a lot of people thinking that we're headed that way again, but only time will tell. It's right at 1 o'clock. So I'm going to go ahead and get started. If you have any questions or anything that you want to ask, there should be a chat feature here. And if there is, just go ahead and let me know. Send something here. I'm going to be watching it, and we'll try to get all your questions answered. The other thing, if you have any questions or you have any concerns after this is over, please feel free to call one of the branches and they can get in touch with me. My phone number here is 864-916-2563, and that will put you directly into my voicemail. You can ask me any question. If I don't know the answer, I will get an answer for you. So let's get started. I'm going to share my screen so that you all can see what I'm looking at, and we will get rolling. The biggest thing in positioning yourself for home ownership, what we see in today's market are rising interest rates. Obviously, you all are seeing that just like we are. Mortgage rates have climbed to 6% in the last 2 weeks. That is the highest they've been in at least 10 years, if not longer. So if you already refinanced, good for you. If you're thinking about it, let's get it before it gets too much higher. The market is anticipating a little bit higher. Prime is currently at 5. It had been at 4, and we are expecting that to go up again. Secondary, everybody's seeing it. Inflation. 6 months ago, a thing of mushrooms at the grocery store cost me $1.99. The other day, I was looking at $2.69, and they called it a sale. That's inflation for us. It's the highest it's been in almost 40 years. It's over 8%. The Fed, I'll reserve my personal comments on how bad they missed the mark on that, but they obviously did, and now they're trying to curb those rates of inflation without creating a recession, because what normally happens is inflation occurs, prices rise, people begin to buy less things because they can afford less things. And that slows down the market a good bit, which then sometimes puts us into a recession traditionally. But it does lower the inflation rate because the heat of the market with everybody trying to buy slows down. We serve 2 different states, mainly South Carolina and Texas. And so with that, we have seen some supply chain issues. We have seen fewer houses on the market currently. That's not to say that they're not being built, because if you live in upstate South Carolina, you know this market is on fire. There are houses being built everywhere. From what I can tell from our ladies out in Owl Park, Dallas and the surrounding metro area of there is going crazy as well. Y'all are seeing it in Wichita Falls. That is going to continue for a little while. The supply chain issues that we began seeing during the pandemic with things like toilet paper, chicken, all of that has calmed some. But I'll tell you one of the interesting ones that I'm hearing about from some friends. A friend of mine's husband's a beverage distributor, and apparently there's some problems getting beer in certain places now. So that's a supply chain issue. I do know that lumber prices had skyrocketed. They are beginning to come down, but they are not coming down at the rates that contractors and builders would like to see. If you are looking at a bidding war in a house, we are hearing a lot of that. We are also hearing again that houses are going for more than the asking price once again. That can be a big problem in the mortgage market. And the reason is because if the house is on the market for $250,000 and you can put down, let's just say you're putting down 3%. That's great. Couple $1,000, maybe you've been saving up for a while. If you put in the bid at 250 and the house appraisal comes back and it's 250, everything's fine. But if somebody steps in and offers them 260, your mortgage company is not going to finance 260. They're going to finance the 250 that was agreed upon by the appraiser. That leaves you at that time to decide if you have another $10,000 to meet the new higher bidding price for the bidding war. That is a big issue right now. There are a lot of people who are wiping out savings to meet the difference in the appraised value and the bidding value war. And so we are seeing that. It is kind of scary. It is what began occurring in 2004 through 2006 before the bubble burst in 2007. However, the difference between now and then is that beginning in 2009, house building slowed down. House building was at a virtual standstill all of 2020 and most of 2021 due to COVID and different things like that, especially the supply chain. I mean, if you were looking at lumber at all, you knew that Home Depot and Lowe's barely had any in 2021. So the issue now is all of this is ramping up. That does contribute to the inflation. It does contribute to the bidding wars because the houses are not already built. So what is built is in high demand for the people trying to move around. So it is, in my opinion, it's very much a seller's market right now. There are a lot of things with home ownership that sometimes, you just think, oh, I'm going to make the mortgage payment and that's cool and that's it. Because if you move from being in a rental to being in a house, you don't realize some of the other issues depending on how your rental was set up. You do have your traditional mortgage payment. You've got to remember utilities. And a lot of times, if you came from a rental place, you did pay your power bill, but you may not have paid your water bill. And if the heat was gas, you may not have paid the gas bill. And if you're in a condo kind of situation, you probably didn't pay a separate trash bill, because the condo association did it as part of your HOA dues, which you may actually still have in looking at a mortgage in a house. Maintenance and repairs. My biggest issue with this is if you are in a brand new home, if you're in a new construction home, the builder should be offering some sort of home warranty. Please take it. It is a little bit more money, but in a new construction home, it covers the majority of anything that could have gone wrong in building. Sometimes with used houses, I don't know that I would say used, but older homes, let's go with that. Older homes, the warranty won't cover as much. And so having a savings plan in place is a better idea, but sometimes they do. I had a home warranty on a condo that I used to own before I got married, and the air conditioning went out the week I was trying to sell it. And according to my home warranty, they had to fix it within a week. So that was fantastic because it was in August. And so everybody was already busy, but the home warranty per contract had to get it fixed so that I was able to keep it on the market and sell it. So I'm not necessarily a proponent all the time of a home warranty, but I am saying, look at them, see what it covers. If you cannot pay what would need to be paid for if something went wrong, if your home warranty covers a hot water heater, and you know that you cannot save enough money to have a home hot water heater paid out of pocket, then you want a home warranty, because you can probably pay the monthly $30 or $40 of the home warranty, but you can't pay the $4,000 or $5,000 of the hot water heater going out immediately. So there's a trade-off between what you can do and what you want to do, but you do need to be realistic about maintenance and repairs, because once your house is on that mortgage, your name is on that mortgage document, it's yours, and it's yours to figure out, and it's yours to pay for. And you want to make sure that you keep the house in enough up condition that it can serve you in the way that it needs to for your family. The thing that we learned 15 years ago was that home values don't always increase. Sometimes there's a bubble and they decrease. The general consensus in the market is that we will not see as big of a bubble burst. The general consensus in upstate South Carolina is that if we do it all, it will be way milder than it was then. And the truth is, South Carolina experienced some of the least of the bubble bursting. Part of that is due to, everybody always wants to go to the beach, and BMW and ZF and SDW, Eurodrive, Michelin, all those guys, they're usually always hiring, because whether the cars need fixing or we need new tires or there's a machine operation going on, they're hiring. And so our level of unemployment is traditionally lower, meaning that our people can afford the houses they're in. And so, like we're looking at now, we have bidding wars and not enough availability in the market. And so back in 2007 and 2009, when the rest of the country was looking at 14 and 20% drops in value, I think Greenville's was only somewhere around 3 to 5, which was virtually unheard of. So we traditionally have done better. Even with a decline, it usually did not result in people locking down their HELOCs and saying you can't spend anymore, because there still was some cushion there. How much can you afford? So this is a highly debatable slide for many reasons. So if you don't agree with me, that's okay. Let me go ahead and say that. How much you can afford really depends on how much money is coming into your household. It also depends on what you already owe and whether or not you have savings for a down payment. The good news is, in this current environment, there are a lot of options for down payment assistance. So if you don't have a big down payment right now, but you're serious about buying a house, go on to Google, look for down payment assistance loans and grants, go through them. I would suspect that the majority of people in our area would qualify for some sort of down payment assistance, whether it's a loan or a grant. They are out there. Do look them over, do look at the terms, but they are out there, and I would not dissuade you from looking for them and potentially even having one. Especially in the market today, where I'm hearing about rent being $1,100 to $3,000. I'm going to just tell you, my mortgage is nowhere close to that. So if you can get some assistance for a down payment, you don't have a lot of debt, you've got good monthly income coming in, go ahead and look at a house and get some assistance for your down payment, because that you'll be better off in the long run. Because your mortgage, if you go with a fixed rate, which we'll talk about in a minute, that payment's not going to change, whereas rent's going to continue to change. How to know if you're ready? Okay, debt to income ratio around 28%. This is traditional. There are places that are still sticklers for this, but not everybody is. The old rule of thumb used to be that you take your annual income and you multiply it by 3. So that if you made $50,000 a year, you're looking at a $150,000 house. That is no longer the case, because tell me the last time you saw a $150,000 house that would afford a 4-family of 4 adequate space. I personally, the cheapest one I found in Greenville is a townhouse for $180,000 over on the other side of town, and I don't know that 4 people would fit in it. At least not comfortably. It would be difficult. I have found some in the $150,000 range, but they have to be gutted. And usually when they have to be gutted, now you're talking about cash outlay, not part of your mortgage. And that's a whole different ball game that you don't want to get into. So what I would tell you is look in general for somewhere around 4 times your annual salary, but make sure, and hear me well when I tell you this, make sure you look at the terms of your loan so that you know exactly how much is going out every month. And we'll get into what pieces of that is. But debt to income ratio, 28% is traditional. I do know of some places that have looked at 40. And part of that's because rent is so high right now that they know if you could pay rent at $1,500, you can pay a mortgage at $1,000. And so they're getting a little bit lax on the 28% piece. Lifestyle today and in the future. You know, if you're an on-the-go person and you don't know that you're going to stay in the area that you're in very much, I don't know that I would buy. I might rent just so that if I wanted to pick up and go, I could. However, If you're planning to stay in your job for the next 10 years and your house is going to fit your family for the next 10 to 15 years, go ahead and buy it. Make sure you have what you want, what works for you, and what works for your family. It's a good tax deduction, but I'm not a tax accountant, so make sure you talk to somebody about that. But in most cases, the interest is deductible, and it's a good deduction for you. Here's the biggest catch. It is a personal decision. If you don't want to be responsible for the yard, if you don't want to be responsible for the pipes, if you don't want to be responsible for painting the inside or the outside or any of those things, then you don't want to own a home, because those things are going to come, and they're going to come every day, and you're going to have to deal with them every day. But if the thought of being able to manicure your own lawn and plant the flowers you want and paint your kitchen the color that you want is something that you find that you really like that idea, then maybe home ownership is for you and you're willing to put out the time and money. But you do want to think about that, because those are decisions that will fall at your doorstep when you own a home. We had a question. I'm going to go ahead and answer this question before I move on, about if you had a current home and you were looking at a rental property, as making it a rental property while you buy another house. This is really where the debt to income comes in. And there are a couple things you'll need to know. When you go to get the mortgage for the second property, they're going to look at debt to income. And one of the questions they're going to ask you is, where are you going to get the extra income to buy this house? So you will need to have a plan for showing that you're going to rent this house out. In the VRBO, Verbo, however you want to call it, Airbnb, all those things that are going on now, it's a pretty solid game that you will get that rented out, and it will, over the course of time, pay for itself. But there are two side issues that I want to note. I don't necessarily think it'd be hard to get a mortgage on a second property. People do it all the time. It's why you see some people with a beach house and a regular house, or a mountain house and a regular house. I mean, it happens. There's a lot of people that do it if they want the responsibility for it. There are two things I will tell you that don't really have anything to do with mortgages, but they do have to do with the actual house. And the first one is insurance, because when that piece of property is now Verbo or Airbnb, it is considered commercial, and you're going to need to make sure you have the proper coverage on it, especially when it comes to liability for anything that happens on that property. And you need to make sure it's listed properly, because the one thing you don't want to do is have somebody who is a renter for a week, 2 weeks, come in, burn your house down, and get hurt. Because if you still have it listed as you live there, primary residence, your insurance company is probably not going to cover that, because it was being used for a commercial purpose and you didn't have the liability that you needed for that. So you're going to need to talk to your insurance agent. The second thing is taxes, because the income that you're making off of that is paying for the mortgage, and it is paying for upkeep, and it is paying for utilities, but those people are paying you, and the IRS wants to know. So you're going to need to make sure that you talk to somebody who knows taxes very well and has worked with people who have rental properties to make sure you don't end up in an instance where you aren't paying the required taxes by the IRS. It sounds like a lot. It's not. It's really a couple conversations, as long as you make sure that you communicate what you need to know. Having two mortgages, people do it all the time. Sometimes it's on one property, sometimes it's on two properties. If you currently have a first mortgage and a HELOC, you technically already have two mortgages. So if you're looking at doing a rental property, it's just two mortgages. It's just on two different pieces of property, which is actually better, because each mortgage is secured by a separate property versus both mortgages being secured by the same property. So I hope I answered your question. If I didn't, like I said, give me a call, 864-916-2563, and we'll go into depth a little bit more. There are a couple of different kinds of mortgages in the market, but the reality is you've got to know what each kind has in it. And so when you make a mortgage payment, there are two main parts. The principal, which is actually what you paid for the house. And that is, if you paid the $250,000 for the house, your principal is $250,000. The other part of that payment is the interest, because nobody gives away money for free. There's no such thing as a free lunch, and that is very true. The interest portion is the cost of having borrowed. And so every payment that you make, a little bit of it is for the principal and a little bit of it goes to interest. And as in the beginning, more of it goes to interest and less of it goes to principal. But as time goes on, the interest comes down and the principal piece goes up, and that's how you pay it off. That's how it works with any loan, whether it's a car loan, your Visa card, your mortgage. There are always two parts to every payment. What sometimes people miss when they look at mortgage payments, insurance for your house, if you have a mortgage, you're required to have homeowners insurance on it. And that's usually paid yearly. You're going to have to pay property taxes on it, no matter where you live. There are a couple states that you don't have to, but the main ones we work in, you do. And they will put a tax lien on your home in the state of South Carolina, and they don't play about that. And it does affect a lot of things. So please, 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 if you can't pay the taxes on a home, get with the tax assessor and work out a payment plan with them. There's also what's called PMI, and that is usually what happens if you don't have a 20% down payment, which most people don't. You'll be paying extra insurance to ensure that you're going to continue to pay and the house is going to continue to go up in value and yada, yada, yada. It's usually less than $30 a month, depending on how big your mortgage is. Sometimes it's bigger if you've got a really big mortgage. A lot of financial institutions will require that you escrow your taxes and insurance, and they'll take the insurance, the taxes, the principal, and the interest and roll it all into one payment. That makes it really easy for you. And the reason is because then they are responsible for paying the insurance when it comes due, and they are responsible for paying the taxes when it comes due. Every now and then they'll kind of miss the mark, and you may owe a little bit more for taxes, or you may owe a little bit less. So and they'll just redo it. And so every year you'll get a notice, hey, your bill dropped by $4 a month this year because your insurance was less, or hey, your bill is now $6 a month because your taxes in the county went up. But usually it's not anything major, unless your county really did a couple more mills or your insurance skyrocketed. It's usually within $5 or $6. It's not a lot. A lot of people like this because it makes it easy. It's one payment. It's less you have to worry about. A lot of people don't. And the reason is because sometimes in some markets, you can take the money for insurance and taxes and put it in another account and earn more interest than you will at the escrow account at your financial institution. In the last 15 years, that has not been the case because rates have been so low that it really didn't matter. I think you're going to see that being a little bit different now that we've got some inflation, we've got some rate changes. Some people may want to do that. And the truth is, sometimes you don't have a choice because the financial institution requires it, but sometimes you do. And so it's really up to you whether or not you want the responsibility of dealing with these things, or if you want to pass it off to the financial institution. In some respects, let them work for you. In others, maybe you want a couple more dollars a year with that money that's already yours. So it's just a trade-off as to what you would like to see. There are really two basic kinds of mortgages. There's variable rate and there's fixed rate. Variables have gotten a really bad name in the past, and part of that, let me go ahead and say, it's not the variable loan's fault, okay? It's the financial institution that wrote that line. And the reason is because there were some financial institutions that did not have ceilings and they did not have ratchet numbers. What I mean by that, in a variable mortgage, there's a rate that you're not going to go below. In the last few years, it's been 4%. It's just prime, it was 4%. It's not going to go below 4%. As rates change in the market and that variable starts going up, a good financial institution is going to have a ratchet number. And by that, I mean, they're going to say, okay, no matter what the Fed does, no matter what happens, we're only going to increase by this amount for this amount of time. Traditionally, it's around 2 to 3%, and they're only going to do it once per calendar year. So if the Fed goes up 6%, that financial institution is only going to be allowed to do 2% this year, but they're going to do 2% next year. They're going to do 2% the next year. But that ratchet doesn't immediately just do the 6% jump. In the past, some financial institutions have allowed that 6% jump, and that has done a huge disservice to the people trying to pay the bill, because that interest goes up, meaning now your payment goes up, and it went up by at least 6%. And that's a problem. There's also, some of them did not have ceilings. And by that, I mean, no matter what happens in the market, the rate on this mortgage is never going to go above this. So even if the current mortgage rate in the market is 18%, if your document says it's never going to be above 11, then yours is never above 11. So variables got a bad name because financial institutions were not disclosing the information well to the member or the consumer. And in some cases, the consumer didn't read the documents and they didn't realize what they had agreed to, because the financial institution did not really tell them very well. And so if you're going to do a variable, make sure you understand the nuances of it. What's my lowest rate? What's my highest rate? How much can you increase it in a year? Those are the 3 questions you want to ask. And if you're comfortable with those floors, highs, lows, middles, whatever, then it's a great tool, because it usually starts out at a lower rate than a fixed rate mortgage. And so your payment's lower. So if you're just starting out with a new home, you're willing to take a little bit of risk, it's a great option. Fixed rate mortgages are pretty much what you traditionally hear about is, I got the same payment for 30 years. I pay the exact same thing every month for 30 years, and I'm going to make sure I pay it off before I retire. I tell people a lot of times, if you're planning to be in the house that you're in for a long time, 30-year fixed is fine. It's a long period of time. You're welcome to pay it off as much as you want. You can pay it down. You cannot. It's great. I hear a lot of people in the Dave Ramsey deal going, we have a 15-year mortgage because it needs to be paid off. Yes and no. If you know you can make the 15-year payment, go on and get the 30-year mortgage and make, Michael Parker thoughts. This is not Secured Advantage. Let me back that up. If you know that you want to pay it off in 15 years, then pay it off in 15 years, but have a 30-year mortgage. And here's why. And I've seen this happen in numerous occasions. They have to have a 15-year mortgage. They have to have a 15-year mortgage. Now their payment's up here, right? It's required to be up here. And one of the spouses loses a job. Now what do you do? Because you can't pay that 15-year mortgage anymore. Now you're late. You're having to refinance when only one of you has a job, which is going to be a problem for the mortgage company. I'm just telling you it is. If you have a 30-year mortgage, which obviously the payment on a 30-year mortgage is like this, and the 15 is like this, when somebody loses their job, just revert back to the 30-year payment for a while. You're still okay. You're also probably paid ahead, because a lot of places allow you to pay at least 1 month ahead. So you might even be able to write them and say, hey, listen, we're not going to make a payment in the month of May. We're having some problems, but we should be paid ahead because we've been double paying. And you'll pay it down in the 15 years, just like you were going to. Yeah, the interest rate's a little bit higher, but if you're paying it down that fast and you're making a principal payment every month, it's going to be minimal in the long run. If one of the spouses' jobs has some questionable options. I mean, it's not always great. That's just me personally, because I've seen it happen where I've seen it happen in some friends of mine's life. And so that's one of my soapboxes is get the 30 and pay it off in 15 if that's what you want to do. The biggest issue with either of these is choose your lender wisely. Ask questions. If you don't understand it, say, hey, I don't understand that. I don't do this for a living. You do. I need to understand this. Do not go away questioning what did I do when it comes to your mortgage loan. You need to understand the principal. You need to understand the interest. You need to understand what can change. You need to understand what you're responsible for and what they're responsible for, and get it in writing. If somebody in a financial institution is not willing to put it in writing, you look at it a second time, because we have to document everything. because everybody's auditing us for anything. So if they make you a promise, get it in writing. The types of mortgages, the USDA, the FHA, VA, and jumbo loans. USDA is basically usually farmland or very, very rural land. They do have a lot better rates, but they have a lot of stipulations. And so if you believe that you're getting ready to purchase a home on USDA approved land, do go talk to them, because they do have some great options. FHA, Federal Housing Authority, you usually can navigate a little bit with them. They do a good bit. VA loans, I can't say enough great things about them, but they do have some restrictions on how many times in your lifetime you can have a VA loan of this kind. So make sure that you use those options wisely for VA. Jumbo loans. When I started in this business umpteen years ago, a jumbo loan was anything over $300,000. Now, as of 2022, $647,200 is a jumbo loan now. And there are rates and terms that are different for mortgages over that amount. That is a federal number, but the state of South Carolina and the state of Texas have adopted that as their jumbo loan. I am not well versed in any of these loans other than what I've told you. I do know a little bit more about USDA and VA just from personal experience, and that's why I'm saying use them and use them wisely, because they can really do well for you. Documentation that you'll need. One of the things you'll find with mortgages, you feel like you're signing away your firstborn, but there's a reason for that. You want to make sure that you never take anybody's home. And so we document as much as we can to make sure that we know enough about you that we're making a good decision and you're making a good decision. And so we want to know where your income is coming from. We want to know what kind of payment history you have, because if we can see that you've been paying rent for 10 years, you're probably going to be able to pay your mortgage and we're going to be okay. How you're going to fund your down payment. Remember, I said that about payment assistance, getting a grant or getting a loan. That really doesn't affect your mortgage. I mean, in terms of, if I saw somebody coming in who had a down payment assistance loan in addition to the mortgage loan I'm going to give them, and I do the math, and it looks like between their mortgage and their down payment assistance loan that they're now going to be paying $1,100 a month. But I see that they've been paying rent for 3 years at $1,500. I'm making that loan, because the reality of the situation is if you can afford $1,500 for 3 years, you can afford $1,100. So I don't care that you have that other loan for the down payment assistant. I'm making sure you're getting what you need. And I would guess that you want to be responsible for your own home, and you want to make sure that that is your asset in life. And so don't worry about, well, I don't want them to see I have a down payment assistance loan. The truth is, it's not really that big a deal. We know that if you've already gotten that loan, that you're committed to that loan, that we're going to get our down payment. And so that's okay. It's really okay. Don't see it as a negative. See it as a positive. Just make sure that when you start doing your math, that you include that as one of your monthly debts. If you're self-employed or you own rental properties, you're going to need to probably bring somebody your tax returns, because we're going to need to see where that money is. And I know self-employed is a little bit hard because you're trying to get your tax number down so that you don't pay as much taxes. I mean, everybody wants to get their taxes down, right? But we can look at it and tell really, what you're bringing in, and that your debt to income's okay, that your business is thriving. That's usually why we ask for 2 years. I've heard in some instances lately they're asking for 3, but that's because of the pandemic, and a lot of people's businesses were negatively impacted by the pandemic. So they want to see 2019 before the pandemic occurred. So if you're up here and you're doing great in 2019, and then it kind of tanks in 2020, but it looks a little bit better in 21, and you're still heading up in 22, then they want to be able to pull 2020 out and be like, that's an anomaly. You got a really strong business, and we're okay with your income coming in from that business. If you have any other additional income, whether it is alimony, child support, some people work some people have trust funds. Not one of those people. I've tried to talk to the grandparents about that for years, but no such luck. But those all are income. If you have an investment portfolio that you're using some of that interest income from, that needs to be disclosed, because we will see that as the opportunity to be able to pay. And the ability to repay a loan is one of the biggest issues that lenders of any kind, whether it's a mortgage, a Visa card, a car, if we see that you can pay it, that's the biggest step forward. And that's what we want to make sure of. Obstacles. If there are issues, I'm going to tell you how to make the process as smooth as possible, because buying a home is not easy. Buying a home is it's timely. Sometimes it hurts if somebody else gets the house you thought you wanted. Sometimes it's just difficult. Sometimes you're like, I just don't even want to go through all this paperwork. I don't want to fill all this out. Let me tell you how to make it a little bit easier. Look around, see who you might want to give your mortgage to. Do you have somebody at this credit union? Do you have somebody at a bank? Is your neighbor a mortgage broker? If so, go have a conversation, because you need to find what's best for you and for your family. So go have a conversation with a lender that you think you might want to work with. Go ahead and get the documentation together that they need to go ahead and get pre-approved. You don't have to have a house in mind. They can look at your debts. They can look at your income. They can look at what you're trying to do and say, hey, you say you don't want to spend more than $275, and that's cool. It's totally up to you. But based on our numbers, you technically could go $300. It's okay. So that when you go house hunting, you can say, okay, this is my range. I want $275, but I'm willing, maybe my comfort zone, even though the bank said, credit union said $300, I'm only cool with $290. It's great. Now you've got a window to work within. You need to determine how you're going to put down the down payment and how much. Just because somebody wants a 20% down payment does not mean you need to give it to them. I mean, I'm the lender and I'll tell you that. Do what is comfortable, agree to what is comfortable, and go look at down payment assistance for anything else that is required. Because we do, 99% of the time, we do want somewhere between 3 and 5%, just so that you have skin in the game, in our opinion. Now, if you get that 3 or 5% from a down payment assistance loan, hey, that's okay. You still have skin in the game. You took the time to do it, so it's okay. A home buyer's agent, this is somebody that goes to the table for you that says, this is what my client's willing to do. This is the house they're willing to look for. They do cost money. Sometimes the seller will pick that up, but sometimes you pick that up. That's very much personal preference. How do you stand out among bidders? We got our house because we met the lady and she said, I like y'all. Your husband made me laugh. You seem smart. I think y'all are going to make a family in this house. I'd rather sell it to you. At that point, it really didn't matter what anybody else was, if we were all close. She was determined this was the family she wanted. So if you can meet the seller, that's great. If you can't, stand out to the seller's agent, because they do recommend, hey, these guys, they came in and they were all excited. They love the colors you chose. They're not planning to change anything. That, for some people, that's huge, because while they're selling their house, there's always a nostalgia piece to, well, this was our first house. This was where our baby was born, la, la, la. And if they think somebody's going to have the same love of their house that they did, you kind of move up in the game of people we want to have our house. So look for ways to stand out among the bidders. Do I have any questions? I'm trying to see. I'm gonna stop sharing my screen and go back to just full. But I'm not seeing anything here.
If anyone has any questions, just make sure you unmute yourself.
Yeah. Thanks, Frank.
I have a question.
Sure.
And I apologize. I wasn't able to join until about halfway through. So hopefully I'm not asking something that's already been answered.
It's okay.
But I'm wanting to know what kind of things to consider if you're a homeowner, you want to keep your house, but at the same time purchase another, like maybe use your
Right.
first home as rental property.
Right. So I actually did answer that one, but I don't
Oh, I'm
mind doing it
sorry.
again. No. You're fine. You're fine. Um, there's a couple things. The debt to income ratio is the biggest deal that the lender's going to look at, because they're going to want to make sure you can make both payments. So if you're going to use it for Verbo or Airbnb, you're going to want to make sure that you've got some information to give them on what's kind of going on in the market around you there. It's not that hard to come by. You can find it. It's on the web. But that will tell them that you're going to have the income to do it. It's a little bit different, but it's really kind of close to having two mortgages on the same house. Only this is two mortgages on two different houses, which is better, because you have two pieces of collateral that can be sold in the effort there's something that's going wrong. It's not difficult for lenders. You'll have to keep up with everything unless you're going to hire a property management company. But the two biggest issues that I saw with this are your insurance, because it's now a commercial property, and your liability coverage. And you need to make sure that you talk to your insurance agent about that and make sure you have the coverage that you need, because you don't want to have somebody get hurt and try to sue you. You don't want something to happen to the house and then the insurance company say, well, it wasn't residential, it was commercial technically, and we're not covering it. The second thing is, even though you're going to have it as income and you've got to show that it's income for the mortgage company, the IRS is going to want their piece of that. And so you want to talk to somebody about taxes and where that puts you. Do you want to form an S Corp so that everything flows through? Do you want to do it yourself? Do you want to start, like, all of that needs to be taken into consideration, because if you're just making a couple $100s a month, and it's pretty much just going back into that house, you probably don't want to do that. But if you're going to make a couple thousand a month, you probably need to somehow protect that income. And so that's a tax question. But as far as having two mortgages, that's not a big deal. There are people in this world who have 3 and 4. A lot of people have a regular house and a beach house, or a regular house and a mountain house, and they rent it out. I mean, it's not a big deal. It's just making sure that you can show you have the income to do it, and having a plan for, okay, if the income goes away, what are we going to do? Which house are you going to sell? Are you going to be willing to do it? Is a big deal. But I don't think you'll have a problem, especially not in this day and age. The issue you'll have is finding the house that you want to be your second house, or the house you're going to live in, and then getting it with the way the inventory is. If you already have all that squared away, then my advice is go for it.
And if you want to build as opposed to buying something?
I will tell you, I don't know a whole heck of a lot about construction loans. They are special. And you would probably want something equivalent to a bridge loan that the lender actually wrote for you, and specified for you. And are you in South Carolina? Are you in the upstate?
I am.
Okay. There are a couple of them around here. I don't want to give you my personal opinion on which one to use, but I will tell you to Google that, and you will be able to tell from the feedback online who you might want to go with.
Okay.
That's,
Yeah.
But there are some really great mortgage companies out there, and I know of one in particular, who they knew that the house was not going to sell. This was a couple years ago, but the people were ready to build. And so what they ended up doing, they did a loan where they paid on the house that they were currently living in while the other one was being built. And the mortgage company, they only had one payment until the day that the other house, the construction house, was finished. And they made 2 months of double payments, and that was it.
Okay.
So there are mortgage lenders out there who will bridge for you and who will work terms around for you. But you're going to want to go have a conversation. And so I would do some digging. I would read reviews, very much so. But there are a couple of really good ones here in the upstate, and they're willing to work with you, especially right now. because they know rates are going up and they're trying to get everybody booked as fast as they can. So get out there, and it'll probably take you a day or two to do really good research and find somebody.
Uh-huh.
But you want to talk about construction loans, and even maybe Google second mortgage construction loan or something like that to try to find one of the mortgage lenders that does that. But it is doable. I mean, you could very easily do it if you've got the income to do it.
So one last question about what you've said. Now, as far as the rental, if you decide to do rental, you mentioned looking at Airbnb and Vrbo. Would you not just look at the going rate for rent?
You
Or
could. You
okay,
could.
all right.
At that point, you become kind of a property manager, unless you hire a property management company. And so you're doing all your own background checks and all that kind of stuff. And a lot of people don't want to do that. That's just strictly up to you. That's totally your deal.
So even though you're doing this seminar though, or this workshop or whatever, does the credit union do mortgage loans?
We have a partner that we do them with called MyCU Mortgage that helps you walk through the process. And part of that right now is because of all of the regulation that we have to have. So we walk through the process with you with MyCU Mortgage, and then we help you with that. And sometimes the credit union keeps the mortgage on the books, and sometimes it doesn't, especially if it's a really big one, just because we're not that big. And so we do have some options. Matter of fact, we have a lot of options. I really like MyCU Mortgage. I actually helped choose them when we got out of the game, and we did that in 2016 because of a lot of the reporting that's come down, and the regulation has really been difficult. And we're just not big enough for all the things that they want to do. And so MyCU Mortgage is a credit union service organization. They only serve credit unions. And so we've worked with them for a long time, just kind of getting some help. And they finally said, we can really help you with this. And they dedicated somebody to us who knows our credit union, knows our membership, and they really do a great job. So technically, no. Reality, yes. So we've really enjoyed working with them, and they're a great company, and you can Google them and check them out too.
And I'm sorry, one last
Okay.
question.
No, you're fine.
Down payments for this kind of scenario, that would still apply. I'm not sure how construction loans work.
Usually I have some friends in Alabama who are trying to build a house right now, and what their mortgage company did is they ended up having to put some money in an account that is technically locked down, kind of like a secured loan. The money's there and it's earning a little bit, but they really can't take it out because that's going to be the down payment when the construction loan is finished. But I also know that if you have a house already, sometimes they'll use that house or the equity in that house as the collateral for the down payment on the construction loan. Now, your lender's going to want a lot of information from you if they agree to that, because I've only heard of that in like one or two instances, but I know there are places out there that have done it before. So it's kind of up to the lender, and you really want to make sure that you don't do what's best for them, you do what's best for you. So ask for the moon and see how far they let you get.
Okay.
I mean, here's the kicker. It never costs you anything to ask, and all they can do is say no. But if you say to them, well, you tell me what you want. Now they've drawn a line in the sand. But if you go to them first and say, here's what I want. Now they have to say, are we going to do that or not? What can we do? Okay, legally we can't do that, but we can do this. And it may actually be better than what they would have originally offered, just because they were just going to offer you the standard. But sometimes it hits them, hey, I can be creative. Most of the time, it's kind of like going to a fast food restaurant. You go up, you say, I want a cheeseburger and fries. Okay, great. Nobody really thinks about that. Awesome. But if you go up and you say, you know what, I want a burger, but I don't want this on it. Sometimes the person behind the counter will say, well, then what you want is this. You don't want what you're asking for. You want this. And that is kind of the same thing with a mortgage. If you just go up and you're like, look, I just need a construction loan to get this thing done, and whatever they're going to say, well, these are the steps. But if you go in and you say, here's what I'm trying to do and here's what I want, it makes them have to think, what do we have in our toolbox that we can make this happen? And so that usually is how you hear of somebody doing something that you're like, well, how'd you get that done? Because they asked. And
Yeah.
it forced the person on the other end to think. And I think is something that we've got to make sure that all consumers do. If you want something, ask for it, because either we can do it or we can't. And if we can't do it, we owe you the explanation of why we can't. And if it's, hey, the feds don't let us do that, that's pretty much how it's going to be.
Yeah.
But if it's kind of like, well, this is what we can't do that because of this, but we can do this. You don't ever want to be the person going, no. You don't ever want to be the person squashing somebody else's dream. And so if you think you can help them with that dream, you're going to figure out a way to do it. I mean, there are times our lenders come and they say, listen, Michael, policy says that we can't do this, but I talked to this member and they need this, and here's why they need it. And so at that point we go, okay, well, we can either make an exception or we can do this that's technically within policy and gets them a little bit closer. Because if you get so many exceptions when the feds come in, you're going to have a problem. And then you can't help anybody else going first. But if you can do little tweaks here and there to get somebody to 90% when they would have been closer to 70, it's a win for everybody. And that's really, but you don't know that until you ask for 100 and we say we can only do 90. So that's always my thought process is ask for what you want and see what somebody can do. Throw it out there because somebody's going to want that business.
Thank you.
You're welcome. If you have any questions, call me. I'm usually at Duncan or Simpsonville. I'm actually excited. I get to go to Texas to visit with those ladies at the end of July. So I will be there, but I do have everything set up to work while I'm there. So if you need anything, please let me know.
Okay. I appreciate that.
You're welcome. Anybody else? Okay.
Can I piggyback off her question real quick?
Sure.
And you may not be able to answer this question, but it kind of relates to what she was talking about.
Okay.
If we go back to 2011, somewhere between 2011 and 2014,
Right.
I had a friend of mine who had a second home up in Flat Rock, North Carolina, and it was a second home. They would use it just as a vacation home, but then they also eventually rented it out.
Mm-hmm.
Then it became a situation where they couldn't get the rent. The person moved out. It was a different time, a different place than we are today. So just thinking about what the previous person was talking about, eventually they had to sell it, and they were able to sell it, but I know they were struggling to make payments too. So I'm curious, and this might be more of a legal thing that you can't answer, but between having their own home and then having a second home, do having those relate at all, or are they two separate transactions?
To me,
Does that
they're
make
two
sense?
separate transactions. The only time those two really come together, well, there's a couple times they come together. They come together on your income taxes. They come together if you keep a personal balance sheet, which 99% of the world does not. And they come together for legal reasons, because if one of the spouses had died, how was the other house listed, all that kind of stuff. But the reality is, for most financial institutions, those are two separate deals. And the reason is because those are two separate pieces of property. You could almost, it really oversimplifies it. So hear me when I say I know it oversimplifies it, but it's very close to having two cars in one family. And the reason is because you have insurance and taxes and the car payments, just like you do on the homes. It's not that, oh, you got two people and two mortgages. It's more like, can these people bring in the income to sustain having these two houses? And with it being a rental property, you would assume so. I mean, you really would. But in the event that it doesn't, how bad does it strap them? And are we in a market where the house will sell for what they owe on it? Every day we always end up looking at people who don't pay their mortgage and they only owe $15,000 on a house that's worth $200,000. And we're like, oh my gosh, y'all don't, pay something. Don't get in a mess with this. And so a lot of times if you have somebody sitting in front of you who's like, I'm buying the second house because I want a beach house and that's just how it is. And I am going to have a beach house. They're probably going to sell the house they live in before they sell the beach house, unless they just, have to stay in their home. But it's really two separate financial transactions. They're both going to show up on your credit report. But as far as if you've got the income to pay it, or you're willing to sell it, and you're not going to be upside down in it, it's not that big a deal, in my opinion.
Thank you.
Did that help at all, or did that kind of go around the corner?
Well, it was more for me asking for the other woman here who was on. Just
I
said,
from what she's saying, if she's building, then the reality is she's going to build the home she wants to stay in forever. So she's going to be willing to sell that other home. Yeah. 9 times out of 10. And if she, if she's had it a while, the good chance is she's got a lot of equity in it. So even if you sell it a little bit below market, nobody loses.
That's my situation. I've been in the house 20 years.
Oh, then listen, then you're going to be fine, because you have so much equity in that house you've been in for 20 years probably now, that they're not going to be worried about giving you another mortgage. You have a well-established payment history in that other house, and with the way rental is right now, you should be fine. I mean, I don't see, unless you just have no equity, but I suspect if you've been making payments for that long, You've got some equity.
Okay. But Frank, thank you for asking on my behalf.
Oh, you're welcome. It just made me think, like I said, this was not a case where I owned a home and I said that some other person, I didn't own a home. It was actually some other person who I did know that owned a home. And eventually they ended up selling it because they just could not, they could not get anyone to rent at the time, and they were starting to struggle financially and could not afford to make payments. So eventually they had to sell it. But I guess my thought process was, if they actually just ended up losing it, would they potentially could lose their other house too?
It depends on how they did it, Frank, but probably not, because there shouldn't have been a cross collateralization clause in that. What that means is that this particular asset is tied to another, and most mortgages, that is not the case. They are standalone for that reason.
But even if you're using the first house,
if you're using the first house as collateral, then yes, that could potentially be the case. What I would say to you is, if you're using the first house as collateral to build the second house, that's fine. But to ensure that you don't have that, when you do that when that other house is finished, don't use that as the collateral anymore, unless you want to pull out a HELOC and use cash. And if you do that, that's a whole separate conversation. But if you put a HELOC on the house and pull that cash out, then what you're doing is giving cash to the construction thing, and that separates them completely.
Oh, so you could do it that way.
Yes, ma'am. Especially if you have a lot of equity.
And that's been my thought, is that if the worst that could happen is I have to just sell the house.
Right.
And I feel like I should be able to get, what I need out of the sale.
In this market in the upstate, if you don't, let me know, because that means somebody didn't represent you well in a thing, because this market's crazy. I haven't seen anything like this in the upstate.
Do you feel like it's slowing down some though, or starting to change?
Not where I live. I live in Greer, and no, I don't.
Okay.
I see it. I don't think it's ramping up anymore, but it's maintaining. I mean, it's definitely maintaining. I can't figure out where all the people are coming from. But, off of Highway 101, there are 4 subdivisions getting ready to go in this year.
Yeah.
I mean, and then where I live, not too far off Brockman, there's 2 more.
Well,
And
that's why I'm looking at building. I want to get a little bit further out now because of all the
you and my
subdivisions.
husband, you and my husband, he's trying to con me into that too.
I want to get away.
Yeah, that's what he keeps saying. How about we go somewhere further? I'm like, I do still have to drive to work there, Hoss. But yeah, I understand. And I think if it were me, and hear me well, I'm not giving you financial advice. I'm saying if it were me, if I was going to use the equity in the first house to help me with the second house, I'd do a HELOC so that those 2 pieces of property were not legally tied together.
And you guys do the HELOCs, right?
We do. And part of the reason I'm telling you to do it that way is because when you take the cash from the HELOC, you're giving cash to the other mortgage company. You're not giving the cross collateralization of the first house at all. You are giving cash, because when you walk in with that down payment on the construction loan in cash, there's no cross collateralization there. You still will owe on this other mortgage piece for the HELOC, but that HELOC is tied to the first house, not the second house.
So the only other thing that I was kind of torn about is, do I wait a couple of more years to pay off some debt? Because you did talk about debt to income ratio.
Mm-hmm.
So
what kind of debt is it? Is it unsecured or secured?
Unsecured.
Is it medical or student loan?
No, I may have answered the question. It's credit card.
Okay. Then I'll tell you what else I might do. And once again, this is not Secured Advantage. This is Michael Parker.
Okay.
I might, if it's not too much and you've got room on that HELOC, I'd pay that off, take my cash, sit on it a month or 2, and then go do my construction loan, because that would give time enough for Equifax to show you paid it off and it became a secured loan with the HELOC, and you have cash for the down payment on the construction loan. But that's just me.
But I guess I still have to keep in mind, though, that if something happens and I have to sell the house, I want to be able to make enough to pay all this off, right?
Correct.
Okay.
Correct. Yeah, that's why I'm saying this is me. This is not Secured Advantage. If you know somebody who's a financial planner, go talk to them, because they can tell you, all the more intricate details and help them plan. I'm just telling you, if you don't want the cross collateralization piece, pull the equity out first. If you're going to use that first piece.
Okay.
Yeah. So
I think this was really good. Do you guys do these kind of things often?
This is our first. We were going to see how it went. And if it went well, then we were going to talk about doing some others. So we definitely want your feedback on it. And
it's
and
very helpful. Yeah, very helpful to me.
Good. If there's anything else you want to hear us talk about, let me know. I am not the resident expert, but I am the one who's brave enough to sit in front of the camera. So you may have to hear me again, but we will definitely get numbers and things that we know are true. And then I will tell you flat out when something is my opinion versus a fact, because I think too many people represent their opinions as facts, and that's not necessarily the case.
Okay. Thank you.
Yes, you're welcome. Anything else? Okay. Well, it's 2:03. We got a whole hour out of this, guys. That's really exciting. I thank you all for joining us. I appreciate your participation. If there's anything else you want to hear us talk about, or anything in the market that you want to know about, shoot us an email. You can get to us at memberservice@securedadvantagefcu.com, or like I said, my phone number is 864-916-2563. Call, and most of the time I pick up. Sometimes I don't. Leave me a voicemail. Tell me what you want to hear, and we'll do our best to serve you every way we can. Thank you for joining us today. Y'all have a good afternoon.
Thank you. You too.
Thank you.